I made my first million at 40 and my first billion at 75. You know what the difference was? I stopped doing stupid things. That's it. No secret formula, no lucky break, no mysterious edge. Just fewer stupid decisions, made consistently, for a very long time. Everyone keeps looking for the secret to getting rich, the magic stock, the perfect timing, the insider tip. The problem is, they're digging in the wrong mine. Wealth isn't hiding in some undiscovered formula. It's sitting in plain sight, buried under a mountain of avoidable mistakes. I built my fortune not by being the smartest man in the room, but by being a little less foolish than the average one. People worship intelligence as if it were a magic key, but intelligence without discipline is just leverage for disaster. I've watched brilliant people destroy themselves with arrogance, impatience, and complexity. They chase what's new, trade what they don't understand, borrow what they can't repay, and call it strategy. I simply avoided all that. I focused on the dumb things not to do, and the smart things revealed themselves over time. That's the strange paradox of life and investing. If you just remove the obvious errors, the path becomes clear enough for compounding to do the rest. Most of success is subtraction, not addition. It's less about discovering the next great idea and more about refusing the next stupid one. Avoid leverage, avoid envy, avoid the illusion of quick wealth, avoid people who confuse luck with skill, avoid the noise. If you make a list of all the ways people lose money, destroy relationships, or ruin reputations, and then simply don't do those things, you'll be far ahead of almost everyone. It sounds boring because it is, but boredom compounds better than excitement. So this isn't about hype, predictions, or the next big thing. It's about discipline, patience, and the quiet art of avoiding stupidity. I call it the Munger method. Simple principles that survive every market cycle, every bubble, every generation. No hype, no shortcuts. Just what works when everything else fails. Let's go. Mistake number 1. You're learning from your mistakes instead of other people's. That's the wrong way to live, and the wrong way to invest. People love saying, I learned from my mistakes. It sounds noble, but it's terribly inefficient. I'm not smart enough to make every mistake myself, and neither are you. Life is too short for that kind of tuition. So I decided early on that I would spend my life studying the mistakes of others. Dead people, rich people, smart people, stupid people. Anyone who was kind enough to fail publicly so that I wouldn't have to repeat their errors privately. Most of what I know came from the postmortems of financial disasters. I never cared much for success stories. They make you feel good but teach you nothing. It's the failure stories that hold the real lessons. The same stupid patterns repeat every generation. Greed, leverage, delusion, and the eternal belief that this time is different. The faces change, the technology changes, the language gets fancier, but human nature doesn't. If you understand how people lost money 300 years ago, you'll understand how they'll lose it again tomorrow. Take the South Sea bubble, for example, 1720, 300 years ago. The English elite convinced themselves that a company trading with South America would make infinite profits. The stock soared 1,000%, fueled by rumor and arrogance. People mortgaged their homes to buy more shares. Then, as always, gravity returned. The company had no profits. The shares collapsed, and fortunes evaporated overnight. The phrase, "this time is different," has been repeated before every major crash since. It's never true. History doesn't repeat word for word, but it rhymes perfectly. A century later came tulip mania in Holland. Grown men traded flowers like they were bars of gold. Prices rose until a single bulb could buy a house in Amsterdam. Then, inevitably, someone asked, "Why am I buying flowers for the price of land?" The spell broke. The market crashed. The lesson was clear. People will believe anything when greed blinds them, and they'll call you a fool until the music stops. Fast forward to modern times. Long-term capital management. Now that's a case worth studying. The smartest people in the room, 2 Nobel Prize winners, built a model that said their strategy would only lose money once every 1,000 years. They lost everything in 4. Their equations were flawless, except for the one variable they forgot to include, human nature. They assumed markets were rational. They weren't. They leveraged themselves to the moon, and when volatility hit, they imploded. The geniuses went broke because they believed their math was smarter than reality. That's a recurring disease in finance, mistaking intelligence for wisdom. Then there's Enron, the great American fraud of the early 2000s. Smart auditors, bright analysts, Ivy League executives, all of them fooled by cooked books and creative accounting. Enron looked like a rocket ship on paper. In reality, it was a house of mirrors, with profits that existed only in spreadsheets. The warning signs were obvious to anyone who truly understood how money moves through a business. But nobody asked the simplest question: how does this company actually make money? Everyone wanted to believe the story. Nobody wanted to do the math. And that's how smart money loses billions. And then came the dot-com bubble. I remember watching young investors pour fortunes into websites with no revenue, no plan, and no customers, just a .com at the end of their name. Pets.com, Webvan, eToys, they all went to zero. The story was always the same. This time, technology changes everything. It didn't. The internet changed many things, yes, but not the laws of valuation or common sense. Fast forward again, and we saw the same movie in crypto. New cast, same script. People mortgaged their futures for coins they didn't understand, run by companies with no profits, led by characters who thought compliance was optional. History rhymes again, louder each time, because nobody bothers to read the earlier verses. When I study these failures, I don't feel superior. I feel warned. I take notes. I ask, what was the pattern? What was ignored? What was obvious in hindsight but invisible at the time? Every crash teaches humility. The people in 1720, 1929, 2000, 2008, they weren't idiots. They were humans. And humans are permanently wired for greed, fear, and denial. If you don't understand those forces, you'll be a victim of them. That's why I tell people, read about failure, study fraud, dissect disasters. It's cheaper, faster, and far less painful than learning by losing your own money. Each case you study buys you decades of experience without paying the tuition in bankruptcy court. Now, mistake number 2. You're buying things you don't understand. This one drives me crazy because it's so avoidable. I have a very simple rule. If I don't understand it, I don't buy it. Period. It sounds obvious, but look around. Most investors are speculators dressed as geniuses. They spend an hour comparing reviews on a $50 toaster but throw $10,000 into a stock because some stranger on Reddit posted a rocket emoji. They call it investing. It's gambling. The difference between the two is knowledge, and most people don't have enough of it to tell the difference. I've passed on thousands of opportunities in my lifetime, and I've slept fine. I didn't buy the hot tech stocks of the 90s because I didn't understand their business models. People laughed at me. "You don't get it, old man," they said. Maybe I didn't. But I also didn't lose 90% when the bubble burst. I didn't chase crypto because I couldn't explain it in plain English. Decentralized autonomous organizations, yield farming, staking rewards. It all sounded like the South Sea Company with better branding. Meanwhile, I stuck with businesses I could explain to a 10-year-old. I own part of a company that sells sugar water. People like sugar water. They buy it every day. The company makes money, and I get a piece of that profit. That's Coca-Cola. It's been selling the same product since 1886, and still compounding quietly while everyone else chases shiny things. If you can't explain how your investment makes money, not how the price goes up, but how the business produces cash, then you're not investing. You're speculating on the kindness of strangers to buy it from you later at a higher price. That's not a strategy. That's a hope. Here's a simple test. Can you write down in one clear sentence how your investment generates profits? No jargon, no buzzwords. If you can't, you don't understand it. And if you don't understand it, the market will eventually teach you the hard way. I'd rather miss 100 opportunities I don't understand than lose everything on one I thought I did. That's not pessimism. That's rationality. Understanding is the only real edge in this game. Everything else, excitement, trends, tips, is noise. So before you buy the next big thing, stop and ask yourself, how does this make money? Where does the cash come from? Who pays? Who profits? And why does that make sense? If you can't answer those questions simply and clearly, you have no business owning it. If I don't understand it, I don't buy it. Period. And if you can't answer clearly, sell it today. Right now. Mistake number 3. You're in a hurry. You want to get rich by Thursday. That mindset has ruined more investors than any bear market ever could. Everyone wants the results of compounding without paying the price of time. You see a chart of exponential growth and think, I want that curve. But the part you ignore is that the curve takes decades, not months, not years, decades. I built my wealth over 60 years, not 6 months. There was no shortcut, no secret formula, just the slow, boring process of letting compounding work while avoiding stupidity. The people who try to accelerate it usually end up driving it off a cliff. They want to fast forward through the hard part, the waiting, because it feels unproductive. But waiting is the work. Waiting is the edge. You don't need to be brilliant to get rich. You just need to sit still long enough for compound interest to do its job. Yet most people can't do nothing. They see someone make 200% on a meme stock in 3 weeks and start shaking like an addict. They think they're missing out. They think action equals progress. But in investing, movement often equals mistakes. The big money isn't in the buying or the selling. It's in the sitting. That's what people can't stand. The idea that wealth is built by not doing something offends the modern brain. We're wired for noise, stimulation, and speed. The market rewards patience, and patience feels like pain. I've met countless traders over the years, bright people, quick minds, sharp reflexes. They live on caffeine and adrenaline, glued to screens, watching every tick as if they could will the price higher. They think they're playing chess. In reality, they're playing roulette. Every day they spin again, hoping for luck to favor them one more time. It's exhausting, and it's delusional. Then there's the boring investor, the one who buys a low-cost index fund and goes on with life. No drama, no dopamine, no endless stream of opinions from talking heads on television, just quiet compounding. Over 5 years, the trader may look smart for a while. Over 20, the boring investor wins every time. Here's some math you won't like but can't ignore. 20% per year for 60 years turns $10,000 into $500 million. That's the eighth wonder of the world, compound interest. It's not magic, it's arithmetic. Small, steady gains multiplied over time become monumental wealth. But there's a catch. You have to stay alive, solvent, and patient long enough to see it. Yet most traders never make it that far. They blow themselves up chasing returns that don't exist in reality. They can't resist the lure of fast money. They tell themselves, I'll just trade actively until I build a cushion. Then I'll invest long term. That's like saying, I'll smoke until my lungs are stronger, then I'll start breathing clean air. It never works that way. You don't need to hit home runs. You just need to avoid strikeouts. Wealth is not built by making extraordinary gains. It's preserved by avoiding catastrophic losses. The investor who earns 10 to 12% steadily will eventually lap the one who swings for 50% every year and crashes every third. The math of compounding punishes inconsistency. Let me give you another reality check. Over 10 years, roughly 90% of active traders underperform a simple S&P 500 index fund. 90%. That's not a typo. That's a law of nature. You are not special. You are not the exception. You are part of that 90% until proven otherwise. And nobody ever proves otherwise for long. If after 5 years you're not beating the index, you're not investing. You're gambling. The index doesn't care about your opinions, your strategies, or your cleverness. It just sits there, quietly compounding 8 to 10% per year, rain or shine. No emotion, no fatigue, no panic. That's the competition you're up against. Disciplined, automated patience. You can't outperform a robot if you behave like a toddler. The market rewards behavior, not intelligence. It's not about who knows the most. It's about who can endure the longest without self-destructing. Let me tell you something. Compounding works only if you don't interrupt it. Every time you sell out in fear, every time you chase the next hot stock, every time you decide to time the market, you're hitting the brakes on the most powerful engine in finance. And once you stop that engine, it takes years to start again. Think of compounding as a snowball rolling down a hill. At first it's small and slow. Then, with time, it grows under its own weight. The trick is not to keep pushing it faster. The trick is not to kick it halfway down the slope because you got bored. Most people never get rich because they keep resetting the snowball. I've seen this play out my entire life. In every bull market, new investors appear convinced they've found a shortcut. They think this time the old rules don't apply. Then the tide goes out, and we find out who's been swimming naked. It happens over and over, century after century, because human nature doesn't change. The tools change, the platforms change, but the behaviors stay the same: impatience, greed, and the fantasy of control. The irony is that the real work of investing looks like laziness. You study hard, make a few rational decisions, and then you wait. You wait for your judgment to be proven right. Not today, not next quarter, but over decades. That's hard for people who grew up refreshing stock tickers every 15 seconds. But that's what separates investors from gamblers. Trading is about excitement. Investing is about patience. One seeks stimulation, the other seeks results. Traders feed their ego, investors feed their future. I chose boredom because boredom compounds better than excitement. Now, I'm not saying you can't make money trading. You can, just like someone can win in Vegas. But casinos are built on the math of impatience, and so is Wall Street. Every transaction has a toll: fees, taxes, slippage. Even if you win some trades, the house always collects its share. Over decades, that drag compounds against you the same way interest compounds for you. It's funny, really. Everyone wants compounding on their wealth, but refuses to apply it to their behavior. Patience compounds, discipline compounds, wisdom compounds, but people are too busy chasing novelty to notice that those are the true interest-bearing assets. If you just stick to one sensible strategy, buy good businesses or broad indexes, reinvest dividends, avoid leverage, and sit still, you will almost certainly outperform 90% of the market, not because you're smarter, but because you didn't self-destruct. That's the real edge: survival, outlasting the fools until their luck runs out. Compounding doesn't reward brilliance, it rewards endurance. You don't have to predict the next big winner. You just have to not sell the good ones you already own. The market is a device for transferring money from the impatient to the patient. That's not just a quote, it's an observable truth. The patient investor collects the mistakes of others. Every panic sale, every over-leveraged margin call, every fear-driven exit. Compounding doesn't ask for genius. It asks for time and temperament. You won't see me staring at screens all day or making wild bets on the next tech miracle. I'd rather spend my time reading, thinking, and letting my capital do the work. The less I touch it, the richer it grows. The market is a great servant but a terrible master. The moment you start reacting to it emotionally, you're done. So, if you want to know the real secret, there isn't one, just patience. And patience looks boring until you realize it's the most profitable habit in the world. The big money isn't in the buying or the selling, it's in the waiting. Just buy the index fund, set it and forget it, go live your life. Not exciting, but correct. Mistake number 4. You think diversification means owning everything. Wall Street loves this idea because it keeps you buying. They tell you not to put all your eggs in one basket, and they repeat it so often it becomes gospel. But here's what they don't tell you. If you own every basket, you don't actually own anything. You just own the market, with more effort, more confusion, and more mistakes. Diversification, in its purest form, is protection against ignorance. It's a hedge for people who don't know what they're doing. That's not an insult. It's realism. If you don't understand individual businesses, you should absolutely own an index fund. It's the smartest admission of ignorance you can make. But if you truly know what you're doing, if you understand a business inside and out, if you trust its management, and if you can explain its economics, then excessive diversification is just dilution. You're watering down your best ideas with mediocre ones. I've seen people brag about owning 50 stocks. They think that means they're diversified. What it really means is they've built a homemade index fund, but worse, they can't possibly follow 50 companies closely. They don't have time to read 50 annual reports, track 50 management teams, or analyze 50 competitive landscapes. So they end up reacting to headlines and emotions instead of data and conviction. That's not diversification. That's distraction. I've always preferred concentration with incompetence. At one point, 90% of my net worth was in a single company, Berkshire Hathaway. Was that reckless? Not if you understand what you own. I knew the business. I knew the people running it. I understood how it made money and why it had an enduring competitive advantage. I wasn't gambling. I was betting on what I knew best. Now, don't misunderstand me. I'm not telling you to put 90% of your net worth in one stock. You're not me, and you're not Warren, but you can learn from the principle. If you know 6 truly wonderful businesses in your lifetime, 6 companies with durable advantages, honest leadership, and clear economics, that's all the diversification you'll ever need. 6, not 60. If you don't have the time, interest, or skill to study individual companies, then buy a low-cost index fund and move on with your life. There's no shame in that. The shame is pretending you're a stock picker when you're really just a collector of tickers. The index will outperform most active investors precisely because it never makes emotional decisions. It just compounds quietly while others fidget. The rule is simple. If you can't explain in one sentence what a company does and how it makes money, you have no business owning it. When in doubt, simplify. A small portfolio of businesses you deeply understand will beat a large portfolio of things you only half understand. Mistake number 5. You're bleeding money through fees and taxes, and you don't even notice. People hate this part because it's boring. There's no drama in expense ratios and tax drag. But boredom, as usual, is where the real money is made. Let me show you what one seemingly harmless percentage point does to your wealth over time. Let's say you invest $10,000 per year for 30 years at 10% annual returns. If you use a low-cost index fund with a 0.04% expense ratio, basically free, you'll end up with around $1.8 million. That's what patience and efficiency buy you. Now let's change one small number. Instead of a 0.04% fee, you pay 1% per year. Maybe you hired an active manager, or you bought a high-fee mutual fund. The returns are still 10% before fees, but after fees you keep only 9%. The result? You end up with $1.5 million. That's $300,000 gone, vanished into someone else's pocket for the privilege of underperforming the index. A single percentage point over 30 years costs you the equivalent of an entire house. That's how quietly fees kill. They don't stab you in the chest. They drain you drop by drop, year after year. Now add trading costs. Every time you buy or sell, you pay a commission or a spread. Add taxes. Every short-term gain you take, anything held under a year, is taxed at your highest marginal rate, often 30 to 37%. Long-term capital gains are lower, 15 to 20%, but they still bite. Each sale is a tax event, a little transfer of wealth from your account to the government's. And yet, people trade compulsively. They sell winners too early because they're afraid of losing the gains. They hold losers too long because they're afraid of admitting mistakes. They churn their portfolios like washing machines. And at the end of the year, they're shocked that their strong returns don't match the balance in their accounts. Warren and I obsessed over minimizing taxes and fees for decades. Berkshire doesn't pay dividends. You know why? Because dividends are taxed immediately. We'd rather keep the cash inside the company, reinvest it in more businesses, and let it compound tax-free for as long as possible. Every dollar we don't send to the government this year earns a return for us next year. That's the quiet advantage of tax efficiency. Here's the rule. Your total drag from fees and taxes should be under 1% of your portfolio value per year. If it's higher, you're paying too much for activity that doesn't help you. Go through your statements, your brokerage account, your 1099 forms. Add it all up. If that number is painful to look at, good. It means you're finally paying attention. A quick checklist. Use ETFs or index funds with fees under 0.1%. Hold investments for at least 1 year to qualify for lower tax rates. Avoid unnecessary trading. Remember, every sale is a tax event. Avoid it. The market doesn't care how busy you are. It rewards results, not motion. So the less you touch your portfolio, the more it grows. That's not laziness. That's discipline disguised as inaction. Mistake number 6. You let your emotions make your decisions. This one destroys more fortunes than all the others combined. Your biggest enemy isn't the market or inflation or interest rates. It's you. When the market crashes, you panic and sell. When the market booms, you FOMO and buy. You do the exact opposite of what logic demands. You buy high when it feels safe and sell low when it feels scary. That pattern repeats every generation, like a reflex that can't be cured, only controlled. Take March 2020, the COVID crash. The S&P 500 dropped 34% in a single month. Panic was everywhere. Headlines screamed apocalypse. Fear ruled every conversation. People sold everything, convinced the world was ending. Berkshire did nothing. We sat still. In fact, we bought more. The market was on sale, and we had cash. By August, the market had fully recovered. By year's end, it hit new highs. Everyone who sold in panic locked in permanent losses. Everyone who stayed rational made money. The difference wasn't intelligence, it was temperament. Now, look at 2021, the opposite extreme. Markets were booming, crypto was euphoric, meme stocks were flying. Everyone thought they were a genius. People who had never read a balance sheet were giving financial advice online. This time is different, they said. It never is. Then came 2022. Markets crashed, crypto collapsed, and the same people who mocked caution were begging for bailouts. The cycle repeats because emotions don't evolve. Fear and greed are permanent features of the human mind. You can't remove emotion, but you can pre-commit to rationality. Write your investment rules when you're calm, not when you're scared or greedy. Decide in advance what you'll do in a downturn, how much you'll allocate to risky assets, how often you'll check your portfolio. Then, when chaos hits, follow the plan, not your gut. Here's what I recommend. Write down your core rules. I will not sell during a market crash unless I need cash for living expenses. I will not buy something just because it's going up. I will not check my portfolio more than once a month. I will not borrow to invest. Print those rules. Put them where you can see them. When panic hits, read them out loud. Your feelings are trying to kill your financial future. Fear screams louder than reason, but it's also dumber. When you feel the urge to do something, it's usually the worst possible moment to act. Emotional control is a competitive advantage because it's so rare. The average investor can't sit still when markets move. They need to react, to feel in control, to escape uncertainty. That's how they lose. Death by reaction. At Berkshire, we often sat on piles of cash for years, while everyone else was chasing returns. People called us cowards, dinosaurs, out of touch. Then the tide went out, and suddenly patience looked like genius. It wasn't genius. It was just waiting for opportunity while others exhausted themselves. If you want to outperform the herd, behave differently from the herd. Be calm when they're frantic, skeptical when they're euphoric, quiet when they're loud. Rationality is your moat. Build it wide and deep. Now, let's tie these lessons together into something you can actually use. I call it the 10-minute rationality audit. Take 10 minutes once a quarter and ask yourself these 10 questions. Do I truly understand what I own and how it makes money? Can I explain it in one clear sentence? Am I paying more than 1% per year in total fees and taxes? When did I last sell something, and why? Did I act on emotion or on evidence? Am I diversified intelligently or just randomly? Am I using leverage in any form? If yes, why? How often am I checking my portfolio? What's my written rule for handling market crashes? If I died tomorrow, would my portfolio make sense to my heirs, or look like chaos? If your answers make you uncomfortable, good. That discomfort is honesty knocking at the door. The audit isn't about guilt, it's about awareness. Every time you do it, you close a few leaks in the system. Over years, those small improvements compound, not just in your portfolio, but in your character. The truth is, success in investing doesn't come from brilliance. It comes from consistency. Understanding replaces confusion. Frugality replaces leakage. Rationality replaces emotion. Those are the only upgrades you need. Avoid what you don't understand. Minimize what you give away in fees and taxes. Control what happens between your ears. That's the whole playbook. Because the market won't destroy you. Your behavior will. So protect yourself from yourself. Your feelings are trying to kill your financial future. Don't let them. Mistake number 7. You quit too early. That single mistake destroys more fortunes than bad markets, bad luck, or bad advice combined. Most people can stay disciplined for a few months, patient for a year or two, but almost no one can hold steady for decades. That's why the world is filled with people who almost made it. They start with conviction, follow a sound plan, invest regularly, then right before the results appear, they give up. They change systems, chase something shinier, start from zero, and repeat the cycle until time runs out. Every time you restart, you reset the compounding clock, and that's the most expensive mistake in finance. The truth is that wealth grows slowly at first, then suddenly. Compounding doesn't look like progress in the early years. It looks like frustration. You save, you invest, you reinvest, and after years of effort, the numbers still seem small. It feels like trying to fill a swimming pool with a teaspoon. That's where most people lose faith. They decide it's not working. They tell themselves the system is rigged, that the rich have unfair advantages, that ordinary people can't win. But what they don't see is that the exponential curve is just beneath the surface, waiting for enough time and patience to reveal itself. The first $100,000 is the hardest. It can take 8 or 10 years to reach that milestone, and it feels endless. Every dollar is hard-earned, every setback feels personal, and every dip in the market tests your will. But that first 100,000 is a filter. It separates those who endure from those who quit. Once you pass it, the game begins to change. The second 100,000 arrives faster, maybe in half the time, because your money has started to earn its own money. Then it snowballs. 200 becomes 500, 500 becomes a million, and soon compounding is doing the heavy lifting while you sleep. People look at millionaires and think they got there quickly. They don't see the 10 or 15 years of quiet discipline behind it, the invisible compounding that finally turned visible. That's the cruel beauty of exponential growth. It hides its reward until the very end. The numbers stay boring for so long that only the patient ever see them explode. In my own life, I didn't become rich in my 30s or 40s. I became rich in my 70s. Decades of steady work and reinvestment. Then suddenly the curve bent upward, and everyone called it luck. But luck is what compounding looks like to people who gave up too soon. Every time you switch strategies because you're bored or impatient, you start over. It's like planting a tree and then digging it up every 2 years because it hasn't borne fruit yet. You can't rush nature, and you can't rush compounding. The tree doesn't need more variety. It needs more time. Water it, protect it, and stop pulling at the roots to see if it's growing. That's why I always tell young people to pick a sensible plan, something proven, something boring, and commit to it for 30 years. Buy good businesses, hold index funds, reinvest dividends, avoid leverage, and ignore the noise. Don't change your philosophy every time the wind shifts. Don't confuse motion with progress. Every time you abandon a good system to chase a new one, you pay the price of starting over. The temptation to quit never disappears. In year 3, a crash hits and fear whispers, "Sell before it gets worse." In year 7, your friend doubles his money on some speculative token and greed whispers, "Buy before it's too late." In year 12, progress feels slow and boredom whispers, "There must be a better way." Those are the moments that separate investors from amateurs. Patience is not passive. It's the most active discipline in this game. It means enduring discomfort without changing direction. It means trusting arithmetic when emotion screams otherwise. You don't need to be extraordinary to achieve extraordinary results. You just need to last. People think wealth comes from brilliance. It doesn't. It comes from endurance. The person who can sit still while everyone else panics will always end up owning the assets of those who couldn't. Over a lifetime, impatience is just another word for poverty. The market doesn't reward intelligence, it rewards survival. The paradox is that the longer you stay patient, the easier the game becomes. The early years are heavy lifting, the middle years are momentum, the later years are glide. Eventually, the returns become so large that even if you tried, you couldn't stop the machine. That's when you realize money has started working harder for you than you ever did for it. But none of that happens if you quit early. The curve stays flat forever. That's why so many people live their entire lives in the almost stage. Almost rich, almost free, almost there. They underestimate how slow the beginning feels and how fast the end arrives once patience compounds. Time is your greatest ally. Every rational decision, every moment of calm during panic, every year you stay invested adds another brick to the wall protecting your future. Wealth isn't built in leaps. It's built in layers. Thin, quiet, consistent layers that no one notices until decades later. If you only remember one thing, remember this. Changing strategy resets the clock. Don't do it. Don't abandon a system that works just because it feels slow. Slow is the point. The math of compounding rewards those who stay, not those who flinch. You won't get rich in 5 years, probably not in 10, but in 30, if you stay patient, rational, and consistent, you'll be wealthier than 95% of the people you know. And you'll have done it without gambling, without panic, and without sacrificing your peace of mind. So stay the course. Don't chase shortcuts. Don't start over. Just keep going. The hardest part of compounding isn't the math. It's the patience to let it work. Now, if you've made it this far, you're serious about this. Most people never do. They click away after 30 seconds looking for another video that promises 10 tricks, 5 hacks, or one secret shortcut to get rich next week. If you're still here, that means you've already separated yourself from the crowd. You understand that real wealth doesn't come from predictions or hype. It comes from principles, the kind that work quietly, invisibly, relentlessly, year after year. So, let's take a moment to put it all together, because what you've heard isn't random advice. It's a system. 7 mistakes to avoid, 7 habits to master. If you forget everything else I've said, remember these 7 simple lines. They're the entire philosophy distilled into one page, and they'll serve you for a lifetime. First, avoid stupidity, not seek brilliance. Intelligence is overrated. Avoiding obvious errors will take you further than chasing cleverness ever will. Don't try to be a genius, just refuse to be an idiot. Most fortunes are built not by what people did, but by what they didn't do. Second, if you can't explain it, don't buy it. Complexity is the enemy of understanding. If you can't explain how your investment makes money to a 10-year-old, you don't understand it well enough to own it. Don't let buzzwords and trends seduce you. If you can't articulate the source of profit in plain English, walk away. Third, boring compounds better than exciting. Excitement burns capital. Boredom builds it. You don't need daily action, you need time. Wealth grows quietly in the background while you're doing other things, reading, working, living your life. The investors who can sit still will always outperform the ones who can't stop moving. Fourth, 6 great businesses beat 60 random ones. Concentration with understanding beats diversification with ignorance. Own what you truly know. If you can find 6 companies in your lifetime that you deeply understand and believe in, that's enough. If you can't, buy an index fund and stop pretending you're special. Knowing what you don't know is an advantage. Fifth, 1% in fees equals 3 decades of work. Costs compound against you, just like returns compound for you. Every unnecessary fee, every excessive trade, every short-term gain, you cash out early steals from your future. Be ruthless about efficiency. It's not glamorous, but over 30 years, the difference is enormous. Sixth, your emotions are your worst advisor. The market doesn't care about your feelings. Fear makes you sell too soon. Greed makes you buy too late. You can't eliminate emotion, but you can write rules to protect yourself from it. Set your plan when you're calm, and obey it when you're not. The test of intelligence is not how you act when things go right, but how you behave when they don't. And seventh, wealth rewards those who wait. Compounding is nothing but patience measured in dollars. The longer you stay consistent, the more inevitable success becomes. The market is a machine that transfers money from the impatient to the patient. If you can simply outweight everyone else, you win. Those 7 sentences are my entire philosophy. Nothing fancy, nothing new. Just timeless principles that have survived every crash, every bubble, and every generation of overconfident speculators who thought they were smarter than arithmetic. The rules don't change because human nature doesn't change. But knowing them isn't enough. You have to apply them. So here's something to help you start. A simple 7-day challenge to turn these ideas into habits. You don't need to change your life overnight. You just need to prove to yourself that discipline is possible in small doses. On day 1, write down the 3 biggest financial mistakes you've made. Be honest. Name them, analyze them, and extract the lesson. Don't hide from your stupidity. Study it. That's where progress begins. On day 2, create a short decision journal for your next investment. Write down why you're making the decision, what you expect to happen, and what would make you change your mind. Review it later to see if you were rational or emotional. On day 3, audit your costs. Go through your account statements and reports. Calculate how much you paid in fees and taxes last year. If it's more than 1% of your portfolio, fix it. Every dollar saved from friction compounds for decades. On day 4, look at your portfolio and pick the 3 businesses you truly understand. If you can't explain what they do and how they make money, you don't own them. You're just renting risk. Sell what you don't understand, even if it hurts your ego. On day 5, write your own investment rules, 1 page only. Make them simple and permanent. How much you'll invest, when you'll sell, how often you'll check your portfolio, what kind of leverage you'll never use. Print it and keep it near your desk. On day 6, don't check your portfolio for 48 hours. Just live your life. Go outside. Read. Think. Let the markets move without your attention. It's a reminder that time, not control, creates wealth. And on day 7, study one failure. Read the story of long-term capital management, or Enron, or the dot-com crash. Learn what arrogance, leverage, and groupthink look like up close. You'll see that the names change, but the mistakes never do. Do those 7 things, and you'll already be far ahead of the average investor. Because the average investor doesn't think, he reacts. You, on the other hand, are learning to pause, reflect, and decide deliberately. That's what separates the survivors from the casualties. Now, if you're wondering what to do next, I'll make it simple. Ask yourself, which of these mistakes are you fixing first? Write it down. Start today. Don't just listen. Act. Every habit compounds, good or bad. Build the ones that serve you. If you found value here, subscribe. Every week, we'll take one timeless principle and turn it into a practical habit. Something you can apply immediately to think better, invest better, and live better. The ideas are old, but their power is fresh every time someone actually uses them. Before we finish, let me leave you with a reminder. This is education, not advice. Always do your own diligence, legal, tax, risk. No one can know your situation better than you. But the principles I've shared here are universal. They've worked for a century, and they'll work for the next, as long as human nature stays the same, which it will. So that's it. 7 lessons, 1 philosophy, and a lifetime of proof. Nothing new, nothing flashy, nothing easy, but it works. I'm out. Go do boring things that make you rich.